We're talking about super. If you've got other assets outside of super, that's part of your investment strategy. If you have investment properties, cash, other things going on, then you factor that in too. So you might say, well, I've got 2 investment properties and 200 grand in the bank. Then you might not be so concerned. Part of your plan might be, I'm going to sell a property in 3 years' time.
Yeah, well, it's the conversation like again we were just having with some clients around, they're worth well north of $10 million and got quite a fair bit of property. And so it's like, well, if we look at your overall situation with property and super and everything else, you actually are incredibly aggressive. You hold a lot of property. So then you can balance out what's happening. The other point to note is with superannuation, when you commence a transition to retirement account, it's not like an ATM where you then get a card for your transition to retirement account and you can just go and withdraw. You have to set the drawdown that you want and it will just be paid to your bank account. And sometimes if you want to take a lump sum out, it's not that quick because you might need to sell down on your investment options as well. So welcome back to the Winners Playbook. Josh here with my regular co-host Billy, and what we're going to be talking about today is transitioning into retirement. So you may not want to actually stop working completely. So today we'll be showing you how a part-time plan can bring freedom sooner without draining your savings too fast. But before we dive into our topic, Billy, we obviously just got back from our conference over in the Philippines. Geez, I was going to say last week, but it was only earlier this week. We arrived back in Australia. There's a few tired faces, that's for sure, after some travel, and it was a pretty intense couple of days there, action-packed. What did you think, mate, of our first conference that we threw over there, and we had 100 attendees?
Oh, it's the best conference I've ever been to. Like, I'm still not over it because we got back. I think I came in Monday morning at 10:30 a.m. or something after about 30 minutes sleep on the plane, and then looked at my calendar and almost had a panic attack because it's just back-to-back. Just back-to-back meetings for the whole rest of the week. So I haven't even had a chance to digest it, but it was bloody awesome. And I think we realized the main reason it was so good was the Filipino people. Yeah, like they're just, the amount of energy they've got is insane.
Yeah.
Like one of the, each night you have like a dinners and performances and things like that. And they're just dancing and going nuts. And like Aussies only do that if they've got, 10 beers under their belt. The Filipino staff don't need to do that.
No,
they're just full of energy. So they just brought the whole mood up. And then of course aside from that, it was so well organized. We had really good speakers. Everyone there was nice. It was just awesome. So yeah. What did you think? Because you were more involved in organizing. I just got to rock up and enjoy it.
Yeah.
I think you were more involved in organizing the whole thing.
Well, that's the interesting part, because having normally been just a guest and you sort of go to the conference, you don't really sort of appreciate what work goes on behind the scenes. And yeah, there was a few little things that went on there behind the scenes. The sessions were happening that we sort of dodged a bullet a couple of times on some tech issues and things like that. But yeah, I totally agree with what you're saying there, Billy. Like the Filipino culture bring a ton of energy. Like they're super grateful. They're just so welcoming of us, and the support they provide us is amazing. And yeah, I can second you on the dancing and karaoke, because they love their karaoke and I do not love karaoke. So
now I do have a video of, I'm not going to show it. So if you do it, I do have a video of yourself and Steve, our other director. He sings Sweet Caroline, and it's not pretty. And that was probably the one time the Filipino staff weren't up and about, I reckon. Yeah, they. I haven't distributed it. I'm going to keep it private.
Oh yeah, for sure. That stays in the private archives.
Just my own enjoyment.
I don't reckon we even got 30% of the words out. I reckon we were trying to read off a phone on stage, and Eddie, who's one of the other business partners in the business, so the mortgage broker, he had his phone out, and he's just like, we can barely even see what's going on in his phone. The text is so small. And so I don't know how it sounded out there in the crowd. It couldn't have been pretty. It couldn't have been pretty.
It wasn't ideal. I think you need to move a bit further away from the speakers.
Oh yeah, I don't reckon I've danced and done so much karaoke in my life, because even some of my staff over there that actually work directly with me, were dragging me up for a dance. I'm like, guys, you don't realize my hips don't move too well. These hips are not built for dancing. So, but it got up there and did it.
Going on with our senior advisors, because I'm the same. I'm like, I don't dance, but after a while they chipped away, and eventually I got out there and
they just broke the walls down with me, and then I was like, all right, we're up and we're dancing. But no, it was good. Sessions were good. We're going to come back bigger and better next year, I think, and plan it out a lot longer in advance. Get some good speakers flying in and things. So it could be the start of something really good with that conference side of things. So we'll see how that one plays out. But yeah, travel at the moment is just absolutely crazy. We've got our New Zealand conference upcoming as well that we're going to. So I'm actually going to be there for 2 weeks straight. So I have another conference there straight after it. Trying to tack on a little bit of family travel there at the same time where I can. So yeah, this first quarter is just all over the shop with travel. So not ideal, because it's kind of hard to find your routine again and get your rhythm going. Even just around like exercise and training and things, and your sleep patterns and stuff when you're sort of moving about. So not ideal, but it's a part of the gig. So can't complain on that front. And yeah, we're about a month out approximately from getting into our new office. So in the near distant future, we're going to have our new podcast room set up. So that's going to be quite cool, and some exciting things to sort of come and happen over the remainder of the year. But if we move on into the topic, Billy, we're going to be talking about transitioning to retirement income streams. But the part I want to sort of touch on with this is that traditional, it's called a TTR, is commonly referred to, but it's a transition to retirement account. First of all, when can you use one of those? When is this relevant? And then also, the purposes of why they were, originated from was to help people transition into retirement. But for the most part, people don't actually use them to transition into retirement. There's actually a lot of other strategies they end up getting used for. So yeah, who are they for, Billy? When can you have one? And what are some of those, key particulars around the use of a transition to retirement income stream?
Yeah, it's a good point, because a lot of the laws regarding super are pretty outdated, and we're not going to talk about governments, but they are not motivated to actually properly overhaul the system. When earlier on, when I was in the industry, you could start your TTR pension at 55 years old, and then that slowly increased to 60, and it's been stuck at 60 years old for a long time, and I doubt that'll ever change. Because that's one of the fears we see is like, oh, what if the government tells me I can't get my super? I don't think they can change it, because people in like manual labor type jobs and stuff, a lot of the time they're cooked by 60. Like they need to stop.
Yeah.
So I just wanted to allay that fear. But yes, for everyone from 60 years old, you can start a transition to retirement pension, which essentially just means you're unlocking some access to the super that you've built up. And it's in the form of an income stream. So like you take payments out of your super, you could take it annually, or you could take it monthly, in some cases fortnightly. So you're just starting to draw down on your super. You can do it even if you're still working, hence it's transition to retirement. It's not full retirement. And there's some guardrails around how much you can actually take each year. So that's generally how it works. And then in terms of the reasons for it, like the original intention was, you'll reduce your work hours and then you'll take a bit from super so that you've still got the same income coming in. But the reality is a lot of people don't use it for that purpose. They might use it to access super for other reasons, like to cover some extra costs. They might use it to access super to pay down debt, which can work. If you've got a big super balance and a bit of a mortgage left, that can work really well. Like you just take some chunks out of super, get rid of the last bits of debt that you've got. Or there's some tax strategies as well, which will, if you've got a financial advisor, they'll be all across the ways you can save a bit of tax by using these TTRs.
And because it has changed a bit over the years, Billy, and you alluded to the fact that you used to be able to commence one when you were 55. And I forget the year that it changed, if it was 2017 or 2018. But at that point, there was also the part of the investments, which was, investments inside super are taxed at a maximum of 15%, unless you go into a full allocated pension or a retirement account, and then it's tax free. But what was the year? When did that change, Billy? Because I remember those transition to retirement accounts. There was a point where they changed the actual taxation of them on them. Do you recall when that occurred?
So it used to be, when you set up a TTR, that account used to be tax-free, like the investment returns within the account became tax-free. And then they killed that off a few years back. It was probably around, maybe it was Tony Abbott sort of era, where they tightened up a lot of the laws around super, like they tightened up some of the tax benefits.
Yeah.
And at that point, they said, no, TTRs are not tax-free anymore. It's the same as your normal super, where you've got like a 15% tax rate in there.
So for tax purposes, what we traditionally see is you might have some unused contributions that you might not have been maximizing your super contributions all the years leading up to age 60. You can actually go back 5 years and take advantage of those unused contributions if your balance is below $500,000, or just year to year, you can actually just contribute up to the $30,000. So I can't even imagine how many times I've had clients do that strategy, Billy, where we take a bit of money out, we put it back into super, and we claim it as a tax deduction. Countless amounts of times I've had clients naturally do that one, and the paying down of the debt. There's also another one. We could, start washing out some of that taxable component of one superannuation fund. So we've spoken about that on other podcasts before, whereby if you're leaving your money to your kids and they're over age 18 and they're independent, they generally pay 17% tax on the entirety of your fund, or the taxable component of your fund, which is usually the vast majority of it. But with the transition to retirement account, you can start chipping away possibly at that by pulling out 10%, put it back into your superannuation, and you do that year after year for a period of time to actually reduce your taxable component of your fund. So there's a lot of use cases there that have nothing to do with really transitioning to retirement in a way, but I suppose you argue they can, because they're going to give you a better retirement outcome. So I suppose that you could argue it is sort of a part of a transition to retirement type strategy, but not the original purposes of why the account was actually set up.
It's like most people aren't going to do it just to spend the money, because if you start spending down your super from 60, and you live to 90 plus, that's a long period of time you're going to have to fund. So most people won't do a TTR simply to spend it every month. There's usually or certainly if they're with an advisor, there's usually some strategy around that, whether it's cycling it back into super to get tax deductions, or using it to accelerate debt repayment. They're probably the two main ones.
Yeah, and look, if we talk about that actual traditional way that it would be used, like the common example would be is just some figures. Let's just say you're working and you earn $100,000 a year before tax. So after tax, that's about $77,000 a year. But let's just assume you're working 5 days a week and you want to go down to 3 days a week. So we're just going to do a pro rata on that. So you go from earning $100,000 to $60,000 because you've dropped 2 days. You're working 3 days a week. So your net income would then go from $77,000 a year down to about 50. Okay. But then this is where the transition to retirement strategy or income stream would come in, because you go, okay, well, I still want to maintain my lifestyle like I was earning the $100,000, which is $77,000 after tax. So what you do in that scenario is you'd set up your transition to a retirement account, and then you would simply start drawing out what you need to make up for your lost income after tax. So in that situation, even though your income's dropped by $40,000 before tax, after tax, it's only $27,000, the difference. So you just need to take out then $27,000 a year from your super because it's tax-free. You don't have to take out the full 40K, and then you can basically still live the exact same lifestyle. So that's the original sort of way and purpose and intent of its transition to retirement account. And then you might drop to 2 days and so on and so forth. And eventually you hit a point where you ultimately wouldn't be working again. But I think the key things there that you have to look out for, though, is like you were just saying there, Billy, like if you're drawing down early, you do need to be conscious of the longevity, of your funds, because between 60 and 65, the minimum drawdown rate is 4%. So you have to take 4% if you set up a transition to a retirement account. So you cannot not take it. It has to come out of the account, even though in some situations you can recycle it back in. But what if you talk, Billy, to a part of that of when you start the drawing down phase of your superannuation, and then the importance of like, how do we start structuring some of the investments? Because you're generally not going to be too aggressive or as aggressive as you've been in your investments to date. And how do we sort of balance that? We're taking money out, that share market exposure can get a bit risky if we're drawing just on a high growth portfolio. We just caught up with a couple of clients that are retirees as well, who are, going through exactly these types of considerations. So how do we sort of, approach that positioning in portfolios when you start making that transition?
Yeah, when you're going with your super, you're going from accumulation mode to drawdown mode. So accumulation just means you're adding to your super, right? You're working, you're putting contributions in, but there's no money coming out. You're just adding to it all the time. And while you're doing that, you generally want a growth or high growth type strategy with your super. You want most of your money in share markets because you're just trying to get the best return you can. But once you're approaching retirement or a transition to retirement, you're now going to be taking money out. Like, you now need that money to last effectively the rest of your life, and you're planning to scale back work hours. So your ability to ride out, a share market downturn or a crash or something like that isn't there so much anymore. So at that point, you don't want 100% of your money in stocks, and that's where you want to make sure you've had a look at that investment strategy, and you might have some lower risk buckets in there. So you might have some cash, term deposits, fixed interest, like low risk stuff that's going to give you some protection next time the share market goes through a rough time. So yeah, you'll definitely want to shift the investment strategy around that point in time.
Yeah, because that last big drawdown we've seen, like that COVID one, I seen some people going into retirement, and yeah, when the markets are crashing, and if you're too aggressive, and you need your drawdowns from your account to live your lifestyle, so you're selling down on all of those investments, so you're selling at a loss the whole time. So it's not like those accumulation days where your portfolio drops in value, but if you don't sell at anything, you haven't realistically lost anything besides on paper value, so to speak. So yeah, that's that. I suppose that's the sequencing risk, and people should read up on sequencing risk. Anyone that's listening into, you want to understand a bit more about it, and the risk that you have as a retiree is those years leading up to retirement. If the market crashes and you're too aggressive, it can actually have a humongous impact on how long your money actually lasts, because you start drawing down on it, and it's a real concern to look out for. But there's ways to mitigate for it. Having different accounts, different allocations within the accounts, kind of like that bucket strategy, where you still have a high growth allocation, but then you have some exposed to have some cash or term deposits, some fixed interests. So when those markets do crash from time to time, then you're not drawing down on any of the growth allocation, and you can just ride the wave and then sort of rely upon the defensive allocation within your account. So really important to get the investment mix right in your account leading up to retirement.
Last thing on Josh, like we're talking about super. We're assuming this person or this household just has a house and super and nothing else. If you've got other assets outside of super, that's part of your investment strategy. If you have investment properties, cash, other things going on, then you factor that in too. So you might say, well, yeah, I'm looking at, should I reduce risk in my super? Well, I've got 2 investment properties and 200 grand in the bank. Yeah. Then you might not be so concerned, because part of your plan might be, I'm going to sell a property in 3 years' time. Yeah. So you take it all into account, but generally speaking, yeah, you want to pull back on the overall level of risk you're taking when you come into some sort of retirement.
Yeah, well, it's the conversation we were just having with some clients around, they're worth well north of $10 million and got quite a fair bit of property. And so it's like, well, if we look at your overall situation with property and super and everything else, you actually are incredibly aggressive because you hold a lot of property. So then you can balance out what's happening within super, and maybe we're not as aggressive as we maybe typically need to be or are with most retirees. When I say aggressive, it's not actually that aggressive. It's a more balanced approach, but compared to a high growth approach, it's a bit more conservative. But yeah, I think taking into account the overall asset allocation when you put all of your assets into it is a really good point to note. And the other point to note is with superannuation, when you commence a transition to retirement account, it's not like an ATM where you then get a card for your transition to retirement account and you can just go and withdraw. You have to set the drawdown that you want, and it would just be paid to your bank account. And sometimes if you want to take a lump sum out, it's not that quick, because you might need to sell down on your investment options as well. So you got to look at how much cash you hold in the account if you need money on a quick basis, because it's not like an ATM where you roll up and put the ATM in there, or the card in, and you draw out. I don't know, is that even possible, Billy? Maybe at some point in time in future, there will be a super fund that provides that ability. Who knows? Maybe there's a opportunity there for a super fund to provide a card link type situation. But it's important to note that's not how it operates. So you do want to get your drawdown right and understand how that looks and feels. And if we then get to the closing, Billy, on looking at like tax and Centrelink and where that starts coming into the mix, because when you're 60, you're still not age pension age, so you can't get any age pension until you're 67. So it doesn't really start to get relevant. But how does some of that start coming into the mix around that point when we're talking about this stuff?
Yeah, well, usually with tax, it's not good news, but it is if you're retiring in Australia. You pay a lot less tax, because the worst part of our tax system is income tax. So if you're on a high salary, you're just giving a massive chunk out in tax every year. As soon as you are retiring or even reducing work hours, the tax burden reduces significantly. And if you're using super, there's very little tax around the super system in retirement. So on that TTR pension, as we discussed, you've still got a bit of tax in your account. Your drawdowns are completely tax-free. So when you take money out, there's no tax on that. And if you're working less, you're paying less income tax. And you've got that ability, like if you're reducing work hours, you're taking money out of super, you've got the ability to put some of it back into super and claim that as a tax deduction.
Mm-hmm.
So from that period from 60 years old until whenever you fully retire, there's a lot of tax planning you can do to massively reduce the burden, which you should do, because once you're fully retired, that's it, right? You've got whatever asset base you've got, you need it to last. So if you can save a few bucks on tax through that period of time, it makes a massive difference.
For sure. And another important point I think to note is, like, when you hit 60 and you start that transition to a retirement account, there's some ways that you can then make it a completely tax-free account. Like if you left an employment arrangement after age 60, so let's just say you've worked at wherever, let's just make up a scenario. You've worked at a car dealership for 20 or 25 years and you hit 60, and then you decide that you're going to leave them, take a bit of time off, and maybe go back into work thereafter. You could actually commence a transition to a retirement account, and then it could be converted into what's called an account-based pension, where it then becomes entirely tax-free, not just on the income, but also your investments to a limit, which is 1.9 million now, but it's actually going to $2 million as of July 1st. Correct me if I'm wrong there, Billy. So
It went up to 2. It might be going to 2.1.
2.1.
Potentially in July. Yeah.
2.1, yeah. So you've got space from that side of things. So it's worthy of note, between 60 and 65 is a neat little period where you can possibly speed up how quickly your account becomes tax-free if you do some of the right things, or if not, it just automatically happens when you turn 60. If you have a transition to a retirement account, it actually just transitions into a allocated pension as soon as you turn 65. So some key things to note and understand around that, because it can get quite confusing when you start trying to navigate all of that together. And in closing, Billy, there's some of the other points that we mentioned, like when you're at this stage, well, you could still have some insurances and things tied to your superannuation fund, and you're probably at a stage of life where the kids are hopefully more independent and not really, maybe not living at the home, and your expenses are starting to change and life's starting to look a bit different. Some of those generally worth reviewing and looking at that point.
Yeah, well, we do a ton of budgeting. We do it almost every day. When I say budgeting, not going through your bank statements and things, but just looking at, okay, if you're retiring, what are your income needs? And often insurance is a big deal, because while you're working full time, you need insurance, and you can usually afford to pay for it. When you're fully retired, that can be a huge burden. So we're mostly talking about the big ones like private health cover, life insurance, income protection. So private health, it sort of depends, right? It depends what your retirement looks like, whether you can afford it and whether you value it. But on life insurance, income protection, all that stuff, the cost is tied to your age. So when you're over 60, it gets horrendously expensive. Mm-hmm. So for most retirees, getting to 60 plus, that's when they're reducing and ultimately just cancelling all that insurance, because it just gets completely, the cost just becomes insane. And also you generally don't need it once you're fully retired. Yeah. So covering off the insurance is definitely part of it.
I have seen some nasty insurances from time to time for clients that have held, or people that I've come across that have held these policies, and then it's maybe time to cut ties with it, because it's a trade-off. You by doing that, you're impacting your ability to have possibly a better retirement. So you've got to get that right, but in some situations it may be appropriate. But we'll close out, Billy. We do have a conference. Jeez, it's just conference season. So we've got another conference on Monday on alternatives.
Yep. Yeah, alternatives. Yeah, private assets, private markets. We've spent a lot of time on this in the last year.
Yeah.
So hopefully we have some good solutions for clients coming soon in that space. But yeah, we're going to spend a night at Cape Shank, I believe, meeting a bunch of fund managers and other advisors. So that'll be good.
Should be exciting. Well, we'll call it there, Billy. We'll wrap up for the day, and look forward to catching you there at Cape Shank on Monday.
Cheers.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.